that's the overall picture. Rajesh Kothari is with us, Managing Director at AlfAccurate Advisors. Rajesh, good to have you with us here. Good afternoon. Thanks very much for your time. Even have to just sort of get your first thoughts on what you're seeing out there on the screen with the pressure that we've been seeing for now almost this is the fourth day, started last Friday.
Yeah, I think, one thing is very clear that last 1.5, 2 years have been spectacular returns for all the investors. And as that was happening, one thing is very clear that this year one should not assume very high returns, After such a great return, you might see consolidation, some moderation in returns, but the long-term story is intact. So I think we are in a structural bull market. But if you ask my personal view, in this year, we will see many winners and many losers. So it is going to be a year of stock selection. It is a year of bottom-up opportunities rather than top-down views. A lot of things are happening globally, and therefore it is very, very important to be bullish, but at the same time be prudent. So I think prudence will pay good rewards in the current year compared to last 2 years where throw the dart and make the money. I don't think that this is going to work out from now on. So good market is respecting our quality, which is a good thing to happen. Market will respect skills, which is a good thing to happen, and only the companies which are fundamentally sound, that stock price will be rewarded. Otherwise, there are many companies which have went up significantly without much underlying strong quality and fundamentals. But I think this year probably will not see great returns for that kind of a portfolios.
Rajesh, afternoon. Where does L&T stand in the stock selection approach, bottom up? If India has to do well, if the next decade belongs to India, then perhaps the largest player in infrastructure capital goods can't be left behind. Now, we've got a sharp reaction to the earnings, the margin miss, the margin guidance. Is it a buying opportunity?
Well, currently we do not own this name. And, if you remember last time we had a very detailed discussion on the capital goods sector. There are two types of buckets within capital goods. One is the traditional growth drivers, EPC, road, port, that kind of a capex beneficiary. Another is the new growth drivers, data centers, smart grid, automation, and so on and so forth, the process industries. And our entire portfolio is more focused towards the new growth drivers, who are basically the companies which can benefit from 20, 30, 40% compounded growth, which is happening on that side of capex. So we are holding product companies rather than the companies which are primarily into EPC. And I think as on now basis, that's our view on the capital goods space.
Rajesh, hi, good afternoon. I don't know if you can. Would you share some examples? Because the thing is that these themes are also being sort of tracked and chased very widely in the market. So in some cases, stocks have run up a lot. So can you give some examples where perhaps valuations still justify fresh purchases, where the runway for growth is long ahead?
Unfortunately, I won't be able to comment on stock specific, but let me put in this way. For example, the pump industry. Now, pumps are the wider application, be it a nuclear power plant or be it the industrial capex. Pumps are going to be definitely is a critical component for any capex, correct? Now, in the pump industry, there are only 2, 3, 4 players. And one of the company which we own is the only company in India which has got approval from Nuclear Power Corporation from, I think, last 60 years. There is only one company which can do that. There is a multinational company, debt-free balance sheet, and they are going to be significantly beneficiary of the underlying capex which is happening in the industry side. Similarly, there are companies, like last time we discussed few names, which are our top holdings of our portfolio. These are the companies which are benefiting from the automation of the grid, the HVDC project, because the size of opportunity for this kind of a companies is going to be 2, 3, 4 times compared to what India has witnessed in last 3 to 5 years. So the valuation will always look expensive, but in capital goods, you need to focus on the order book, the order intake, and how your portfolio is positioned, how the company is positioned to capitalize on these new growth drivers. Once this order book translates into revenue, that's where it gives you EPS. But stock price will always focus on incremental order intake rather than the revenue and margins.
Hi Rajesh, good afternoon. One name that we've discussed in the past, I think, is Titan. I think for your clients, you all did hold that some time ago at much lower levels, I think so. But this past quarter's numbers are a little bit disappointing, I think so. How are you all approaching this theme? The management's commentary on the margins itself is a little bit skittish.
Well, I think very important, Nigel, is to look at the margin performance with the backdrop of what are the gold prices. At this kind of a high gold prices, still companies able to maintain that margin. That is commendable job. Now, if you look at the gold prices, the high gold prices will never continue for everyday basis, right? The gold price itself is also a very volatile. So what is most important to figure it out is that how the company does during the bad time of its cycle. In good time, every company will do well. But in bad times, if you can hold the margins, then it means that as and when the gold price correct, of course, then again margin trajectory will come back. But I think that's very small point. More important point is the look at their growth and look at the last 3 years compounded, because in this kind of companies you need to look at 2-3 years compounded growth rather than looking at quarter on quarter, because this people are talking about is skeptical about this company for many years. Every quarter something happens and they say story is gone. But this company has kept delivering, and I think opportunity canvas is pretty large. Company has a competitive advantage, and in such kind of businesses, whenever you see quarterly based some volatility, I think those are the fantastic times to add it to your portfolio, because after 2 years, you will remember that, oh, this was the quarter where I got this opportunity. This opportunity don't come often in companies like what you have mentioned, So please put a disclaimer, because we continue to own this name for our clients in PMS.
Okay. Auto ancillary was a space that you were looking at in our last conversation. Have you made any fresh purchases? Yesterday, Bharat Forge sounded very positive and optimistic about the FY25 prospect. So which stocks do you like over there?
Well, we like auto and auto ancillaries both. And within auto basket, OEM, we prefer two-wheelers compared to passenger cars and commercial vehicles. We own, the top two names within the two-wheeler space. And in auto ancillary space, we own number of companies. These are the companies which will benefit from electrification of the vehicle. Like last time what we discussed, it means more sensors, more cameras, more safety norms, more airbags, and so on and so forth. And there are many companies, most of these companies are debt-free or under-leveraged balance sheet with a oligopoly or monopoly kind of a market share. And they are still trading at below 20 times price to earning multiple, with a potential earnings growth of 20% plus compounded for next 3 years. So it's a very interesting bucket, and I think there are many opportunities within this space. We like this space. We continue to be overweight in the entire auto and auto ancillary space.
Okay, all right, Rajesh, we will leave it on that one for today. Thank you very much for joining in. So stock pickers are all